Okay, good. There we go. Hey, everybody. Don Yoakum. Raleigh, thanks for that. Thanks for great intro. Lots of great music. Welcome, everybody. This week's roundtable. Our guests today are Roger Scott, Les Lindman, Jeffrey Turnmeyer. It's going to be awesome. We're going to talk about the disconnect between interest rate expectations, what the Fed wants, and the markets are trying to press. We're going to talk about how to spot some turning points in major stock markets. And we're also going to talk a lot about some of the, it costs money to short stocks. That's interest rate margin, and margin expenses are going up along with Fed interest rates. And Roger's going to talk to us about some of those stocks that are feeling the most pain, or at least the people trying to short those stocks, how much pain they're feeling now. But I'll let them on in just a second. We've got earnings out so far this week. They're better than expected, but that's in large part due because expectations have come down so Wall Street expectations have come down so much that it was kind of an easy beat. But on the bank side, it's not as bad as you may have feared. Although there's been some notable losses in declines in net income over the last quarter for Goldman Sachs, Morgan Stanley, Western Alliance. Those seem to be the big losers so far, but all in all, there's some big winners out there like Wells Fargo. What was another one I saw? M&T Bank, JP Morgan Chase. But we'll talk about earnings and all that stuff when we get in here. And so please help me welcome Celeste and Roger and Jeffrey. How you guys doing?
We're doing good. I don't have access to turn on the camera. It says my host stopped it. That's why none of us have cameras.
Okay. Yeah. I think Raleigh's on that right now. He's going to let you in. Sorry about that.
That's cool. Thanks, Raleigh.
Awesome. So, Roger,
great.
how are you doing?
I'm doing all right. I'm doing okay. I'm really excited to be here. There's a lot to talk about. This market is gearing up. These earnings are gearing up. Just I think there's a lot of confusion right now in the market. I think price action right now is going a little nuts. So this is a really great time to have a meeting and to get all of you to get all of us together. Hey, Raleigh, can you give me access? I can't seem to turn it on for some reason. It's weird, but we'll get into all of that when I do my my analysis. But it's really becoming a very interesting time, especially in light of the fact that the Fed is going to be more likely than not raising rates over the next when is it, May 3rd? I believe it's set for May 3rd. So we're going to probably see a 0.25 rate hike, and I think things are going to get interesting. And I think the market, oh, there we go. Thanks, Raleigh. Appreciate that. There we go. Yeah. It's easy. It's so funny. It's easier for me to talk when I'm actually have the camera on. I can think normally. The things you get used to in life, right?
Yeah.
But yeah, I think what's going to happen is I think the market is getting a little too exuberant, and I think the economy is not following the Fed right now, and I can't wait to tell you more of that. And I also have some stocks that I want to go through that are looking really good right now, even in the current economic cycle. So a lot to talk about today as we get into this session.
Awesome. Hey, Celeste, how you doing? It's great to see you.
Doing well. It's good to be here. Good to get the video working, and great to be here with you guys. It's always great to hear what your perspectives are and also to contribute. And so just to help us navigate through this market to make some money. That's what we're here for.
Absolutely. And Jeffrey, we got you?
Yeah, I'm here. Still can't share my video yet, but
all right, we're working out the bugs here. Okay, so why don't we kick off here talking about the Fed and interest rates? I mean, so and for all the guests to say, "Oh my God, they're talking about the Fed again," right? Like here's the issue is almost nothing else matters. Everything revolves around the next 5 years. There's Jeffrey. How you doing?
Hey, I'm here.
Excellent, man. I appreciate you joining us, especially on late notice. Jeffrey, last minute, we decided we could get him in here, so it was awesome. Thank you, Jeffrey. Appreciate your flexibility. The Fed is and central banks are driving almost everything, all expectations for the markets, and that's the reason we got to focus on it. And it's not a sign of health. It's not great by any stretch of the imagination, but that's where we are. So, Roger, why don't we start off with you on this kind of disconnect. I wrote about this just a little bit yesterday, and there's a couple of different ways to talk about the disconnect, and I'd like to hear how you think about it. One way is you've just got the Fed kind of talking down the markets by trying to raise interest rate expectations, right? And then the equity markets just hanging in there, not really responding. And then there's another way to talk about that disconnect as well, too, is the specific Fed dot plots. They have at the end of the year, the Fed at around 5.25%, so above 5%. But if you're looking at Fed funds futures, right, where you can kind of price in what those expectations, if you look at the December futures contracts, it's at around 4.5 to 4.75, right? So Fed futures, they disagree with the Fed, and the only one out there really saying we're going to be above 5% at the end of the year is the Fed itself.
It's the funniest thing.
Maybe you, I don't know, but
yeah. Well, so
how's that disconnect? Tell me, what disconnect are you seeing, and what you make of it?
I'll tell you what the disconnect is. It's really interesting, and so it seems to me, that the Fed is trying to convince everybody that what they're doing is working. And honestly, to be really honest with you, I'm not really seeing all that much evidence of it. What I am seeing is so the question is, if that's the case, why are interest rates, why are futures focused towards actually slightly lower than higher if the Fed is saying they're going to raise rates? Well, I think the answer is, I think most investors and the market is starting to anticipate a mild recession over the next couple of quarters. And we all know that the Fed is not going to raise rates if there's a recession. So I think what's going to happen is, I think the result is going to be the same, but for two different reasons, okay? This is where it gets interesting. In other words, the Fed is going to say, well, what we're doing is obviously working. It's not, the core CPI is higher, it's not lower, but which is their number one thing. It was a 4.6, which is the number one thing they look at. So I think what they're going to say is, yeah, what we're doing is working. We're going to raise rates another 0.25, and that'll be it for a while. And I think what's going to happen is they're going to keep saying what we're doing is working, but we're going to just kind of pause. But in reality, what's going to happen is they're not going to say what we're doing is not working, and we're not going to raise rates because we're in a recession right now, which is ultimately going to be the reason why they're not raising rates and why interest rates are going down. I think rates are preparing for a mild recession. I think the inverse curve is here. I think earnings are going to be, and I'll talk about that further, but I think we're going to be in for some nasty surprises this quarter, much like we were for last quarter. So I think ultimately rates are not going to go much higher, but for a very different reason to what the Fed is trying to make us believe and what they're spinning. So they're not going to go up because we're going to enter a mild recession, or we're already maybe in one right now. But their whole thing about we're going to lower rates or we're going to keep rates the same because what we're doing is working, I'm not buying that for a millisecond, okay? I'm looking at the data, and the data is not looking all that great. Maybe what they're doing is starting to work, or maybe there's a lag. But if you look at the Fed numbers right now, if you look at the core CPI, if you look at the manufacturing, if you look at the ISM report from last week, none of that is showing a lot of strength, and a lot of that is pointing to further weakness in the economy. Now, I'm not an economist, but I know I could read numbers, and everything I'm looking at is pointing to weakness. Now, let me throw another curveball here. What has the Fed been saying? Why? I think you're going to appreciate this, Don, too, because you keep your eye close to all of this stuff. You have your eye on the pulse. So what is the Fed giving us as their reason why they can continue raising rates? And because the job market is strong, right? The job market, they're always focused on the job market. The job market's tight. We can continue raising rates. The job market's tight. Well, I'm going to tell you something. If you look at every recession we had, the last thing to go down is the job market. The job market's not usually the first to fall. It's usually the last thing to fall before a recession. That's number one. And number two, and this is equally as important, if you look at the job market right now, you will notice that a lot of what we're seeing right now is built up a pent-up demand from COVID. See, it went from nobody working to a lot of people working to a lot of job openings. So I think what we're seeing right now with the tight market, or evidence of a tighter market than usual, is a lot of the tailwind from the COVID era. And I think a lot of economists are using that data as a means to show that the economy is still humming along. but I don't think that data is very accurate because of what I just said. So
Yeah, there's a lot of momentum that has yet to appear,
yes,
and they're
exactly.
ignoring that was a momentum. Yeah.
Yeah. A lot of things changed during COVID, and a lot like how about export imports? I mean, I don't have to tell you. I mean, look at the relationship between U.S. and China. So a lot of I think what the Fed is doing is too focused on job growth or the stability of the job market, which I don't think is really there. I think if you look around, you will see that there's a lot of holes in there. That's number one. I think that they're not being accurate. And matter of fact, if you were to get the quotes from half the Fed will say our job is not done yet. We've got more to go. I think it's this artificial binary thing that we've got another quarter of a basis points to go. But ultimately, I think it's because I think they're going to stop, not because things are getting better. They're going to stop because things are getting worse. And they're going to try to spin it in their own little way. But job market, I'm not believing it right now. Earnings are going to get worse. And I'll talk about that when we get into the earnings part. But I think ultimately we're going to end up, rates will not go higher for different reason than what the Fed will say. So ultimately, we'll end up in the same position, but for different reasons. That's kind of where I'm going with this.
No, interesting. No, and this morning, the UK inflation numbers came out of the UK, and they're still in double digits. It's over 10%, right? And so they're hiking, and it should have some of the same sort of pressures easing on inflation that we expect here. But it was food prices. They had food prices going up over 20% in a month, which doubles over 3 months. If you guys do the compounding real quick, right? So that's pretty significant. Celeste, what's your read on this kind of disconnect, the trajectory of rates in general, markets, that sort of thing?
Well, for those of you who've been around me enough, you know that I'm a listener. I listen and I observe. So I'm observing, in my own neighborhood and my own community. I hear what you all say, and I have a lot of respect for it, tremendous amount of respect for you, which is why I hang around all you guys. So I listen to these, I put them together, and I do it in a way so that, how can I make money through all of this? So I agree with, 90% of what's been said, all of what you all said today, but I do have a little bit different perspective too. Like I feel like we're more in a rolling recession. I feel like we're really a rubber band. All these effects from COVID and, transpiring into what we're seeing today. So just like, what was it? JB Hunt came out in their earnings call and said that basically, hey, everybody, we're in a recession. And hey, you know what? Our customers are way more optimistic than we are. And we think our customers have never been more wrong. There's this disconnect everywhere. There's the disconnect with the bond market, with the equity market, with the Fed. And I think the only ones that really are paying attention to that are those who are the bond traders and the equity traders. I don't think the Fed is really paying any attention to that. And I think bottom line too, is what my conclusion is what the way I'm looking at this is I can't fight the Fed. And, I think that the equity market is participating in this very much. And I've made money doing that. I think the bond market is very much has an opinion and is leading, and we're going to see how it's all going to work out. But one thing too that I remember, because I listen a lot, is I remember Garrett Baldwin coming on. It was before COVID. It was like maybe a year before COVID. And he was saying, hey, you know what? I think we're going into this new roaring 20s kind of a phase. And you know what? I feel like that's really a lot of what we are doing. And that's why I feel like the jobs market is actually strong. It's incredibly strong in my area. It's incredibly strong in a lot of areas. In the industries that the people that I talk to, they cannot find enough qualified people. So it's like I hear and I see what the data is that's being reported to me. But what I see and observe is very different. The housing market, I mean, houses here are just selling like crazy. And it's a different feeling than what other people might be feeling in the area as far as, the housing market bottom. So I'm just using that as a way, is like, okay, how am I going to use all this to make money? And I'm excited. I've never been more excited. But Don, like when you came on last week on Ask the Pros, I thought it was so brilliant how you compared the rates, like what the problem is with the bank rates now, the problem for the banks. The problem for the banks is that these interest rates are literally all over the place on these different maturing rates here. So like, you got a 3 month, you got a 6 month, you got a 4 month, you got a year. Those rates should, the rates should go up as the time frame goes up, right? But those rates are all over the place, and they're trying to stay in business in that kind of arena. That's nuts. So from that perspective, it's like, this feels like something new. where I'm typically like, hey, history repeats itself a lot. This is something new where we haven't seen a bank have to, perform under those conditions. That's my little 2 cents.
Yeah. Yeah, no, that's great. I appreciate that. And the real one of the big issues is the banks that got all these deposits and they seem to be beneficiaries, right? Now they have to do something with them, right? And they just can't lend them out at a profit, given how much they have to pay to borrow those costs, right? They have to pay too much to keep those deposits, and otherwise they just walk out the door. Jeffrey, what are your thoughts, my man?
You know me, I'm a technical trader, but I do keep my pulse on all this stuff.
Hey, we chat about this all the time. Oh, excuse me 1 second here, guys. I'm sorry. I just kind of screwed up here. There we go. All right. I just wanted to make sure a link was working. You drop me stuff all the time. We chat about this.
Yeah.
I know you think about it. So let me know. Drop it.
About the tight labor markets, there were about 6 million prime age working males missing from the job market for a number of years now. I mean, we've seen this headline over and over. And where I think that chunk of people was in SNAP benefits, which all the COVID era extra benefits expired at the end of March. 42 states ended them just 2 weeks ago.
That's very interesting.
Almost 3 weeks ago. So I have a feeling over the next 3 to 5 months, we're going to see about 6 million prime working age males show back up into the workforce.
Yeah.
And, all these people that were getting this extra money, you could survive on $300 a month. I mean, that's a lot of people that are going to be out there looking for those low end jobs. That seems to be the ones that everybody's looking for work. I mean, looking for people to hire. And,
let me give some context for everybody on that, right? So there's some real window dressing that goes around the way the BLS publishes unemployment, right? And this really picked up pace during 2007, 2008. They started redefining in a significant way. They did it a little bit in 97, 98, 2000, but then they really picked up the pace of how they redefined someone looking for work. So to be part of the labor force, right, you have to be willing to look for work, right? And a lot of people just gave up, and they defined them out and said, okay, well, if you're not actively looking, you're no longer in the job market. So you're reducing the denominator, right? Reducing the number of people that the employment pool. And that's what happened with these SNAP benefits, right? Is I think is what you're suggesting is they're like, okay, I'm getting this money now. I really don't have to do anything. Right.
Right.
So they're not actively looking for work. The BLS says, okay, fine, you're no longer in the job. Look, we got the lowest unemployment ever of 3.4%. Right. So that's an interesting thing to see them come back on, and it'll be interesting to watch what happens to the job numbers, unemployment numbers, because of that. Yeah.
Yeah. And that was just prime working males. I mean, we're not even counting the non-prime males or the females at all in these numbers.
Are you prime? Am I prime? I don't know.
What is prime? That's what I want to know. What is there like a criteria?
Prime is right here.
Prime is like 18 to 50. So
got it.
It's 18 to 50-year-old males.
Wow. Hey, Raleigh, turn my camera on.
I differ with that definition, but anyway.
No comment.
Supposedly that's it. Yeah, that's your best working years. I don't know.
Jeffrey, what we got less, you can end up in the same kind of trouble like CNN host did, right?
That's right. Exactly. Exactly. Yeah.
I'm not saying what a male is, but
oh my. Who'd have thought?
Okay.
Who'd have thought?
Anyway, back on track. That was good. So you got this unemployment numbers that you expect to see coming back up, and maybe the Fed that'll ease the Fed's hand a little bit.
Then a few things, okay, so everybody remembers inflation is transitory.
Oh.
Right? I mean, we're redefining a recession. I mean, how many times are we going to change the rules on this thing? I believe we've been in a recession. The charts show we were in a recession. The GDP numbers show we did a recession. Maybe we're over, maybe we're not, maybe we're coming out. The technicals do tend to lead the actual economic numbers that come out. We tend to bottom in the stock market, October, about 6 months before the actual earnings numbers bottom out for companies reporting earnings. We've seen some strength in banks and stuff like that. We could be we could see a little period where we do actually go higher. We broke out of the downtrend of lower highs that was 2022. We've back tested it. We're moving up. We're kind of testing the resistance from February, trying to break out. We do have resistance from August highs to work through. So we're just kind of chopping right now. We're stuck in a range. If you zoom out on S&P 500, we've been sideways for 2 full years.
Yeah.
2 full
So
years.
where do you think the top end of that range is over the next 6 months, Jeffrey? What do you expect? So if we've made a turn and kind of heading back up, what do you think?
If we can break out through 4,300, I mean, that's going to be a big resistance point. Then I think we could go retest the all-time high from back January 22.
That's what Roger mentioned last week, was 4,300 was kind of his top point. I've been looking at 4,200 on that. So no, good. Well, all right. I appreciate that. That's great insight. Celeste. Okay. Hey, I really want to hear from you on, so speaking of the S&P, are we at a turning point, right? We're at 6 months high, roughly. Bouncing around this 4,200 level, or bouncing off it, however you want to look at that. Why don't you tell us a little bit? I know that you done some research, I think, which kind of COVID or post-COVID timeframe on how you take a look at market turns and that sort of thing. You want to tell us a little bit about that?
Yeah, let me go ahead and share my screen if y'all can see that right now.
Yeah.
So I'm just going to take you back through. This is actually this is the way I've looked at the S&P, the put call ratio. I'm going to take you through the put call ratio, the VIX, and average true range. And you're going to find out, didn't tell you this before, but I've got that 4,300 number on the screen here for you. And you're going to see where it comes from. Okay. So, but the way I've looked at this put call ratio is that if you look at this area back here before COVID, there to the left of the screen, those were kind of the common ranges. Once COVID hit, we bounced down into this range of a put call ratio. This is just the one that I look at. You may not look at it this way, but it was very helpful for me during COVID. I used this all the time to make money. It was very, very helpful. What I noticed is, last year, this range, you can see my solid blue line, kind of moving up, and we kind of moved back into that kind of normal range, making things a little more normal. This high actually, I think it's right here. I think this is the 5-year weekly. But these highs here now, you can even see where I have the yellow boxes. Those are kind of the ranges that I've used. And these highs here on this week have been very, very helpful in pinpointing some key areas. So let me, I think on this next screen here, but hey, I'm going to steal Roger's phrase. I've always learned that the best phrases and the best methods are the ones that you borrow or you grab from other people. But I think the cheese has moved back to that area where we can use this put call ratio a little bit more like what it used to be. And that's this whole rubber band, this whole rolling effect that I've talked about. This is a daily, and this is that blue line that I talked about on the chart just previously. But this right here, I use this more for kind of bottoms in the market than I do for tops. And it's an inverse relationship. But this kind of top here just coincided really nicely with the recent mid-March bottom that we had. So that was very helpful. Let's see, this is the VIX, same kind of thing here that I noticed during COVID. Here on the bottom left, you'll see these were kind of ranges for the VIX. And by the way, this is the VIX futures, and this came from bar chart. This is the VIX futures, but it's a continuation chart. So even though this says this is the contract, the recent contract K23, it's actually continuation, and it's a weekly. So it's kind of averaging things out. But this kind of VIX level before COVID, down here in this bottom left area, while we were in COVID, kind of moved into this area. And now my question is that I'm asking myself, and as I navigate the way I use the VIX, I'm watching these areas here to see, hey, is this going to bounce up? Are we going to come back? Are we going to stay in these kind of COVID ranges for this VIX the way I'm looking at it? Or are we going to come back to what was normal? So I think it was really interesting too. This is what the VIX looks like. This is from TD Ameritrade. I just clipped that off today. And this shows the picture of the VIX, bottoming out yesterday around that 16 range and popping up there at that 19 range. That's an interesting view. You look at some other of the different software kind of things, they show a smoother transition line there. But I just think that's an interesting view. But what I think is really interesting, and just to show you how powerful your man Don is is that, as Dawn had said, I don't know, it must have been 3 weeks ago, might have even been 4 weeks ago, when Dawn was saying that 4,200 level. And this is a picture of the futures. This was yesterday morning, before the cash open. The cash open is right here at this blue bar. This is on the Roadmap software that I use a lot of. But right there before the market opened, we hit that 4,200 level, 4198.25. Sorry, Dawn, you were off. Just
missed it by that much.
Just that much. Now, this is the S&P futures contract, the M23. But you can see how, and this is why I think numbers are so important. When Roger says 4,300, when Jeffrey says 4,300, those are very important numbers. The market does do things around that. Now, did Dawn know 3 weeks ago, or Jeffrey, when he's saying these levels, or Roger, when he's saying these levels, do they know what's going to go on in the market with earnings or unexpected news, or what the Fed is going to say? No, they don't know, but they know these numbers, and these numbers are important. They're very important to me. Now, one thing I have boxed here as well, this is a 30-minute chart. This is showing the average true range, ATR, and this is for a day. This is a daily basis, even though it's on a 30-minute chart. That's a daily. So it's just saying that on average over the past 14-ish days, that the S&P, you can expect it to move about, on the futures, about 45 points on any given day. So keep in mind, because that's going to be helpful as we continue. So I just want to show the picture of this was as the day progressed yesterday. You saw that the little picture that I just showed, the S&P moving at that 4,200 mark and just totally rejecting it. I talked to Don, he said he shorted it. Bravo, great move, made some money with that. And then see what happened in the afternoon. I mean, we just kind of stayed there. We just hung out, kind of expectedly so. Where sometimes, as traders, we like to look at the what's going on in the afternoon. What are the traders doing in the afternoon? Because typically it's the smart money in the afternoon. Well, and that's just typically, I mean, however you want to use that. But this is what happened yesterday here on the right side of the screen. They just hung out. Now, that average true range, still that 45 kind of area. This is still a daily ATR. This is still a 30-minute chart. But now here's what it looks like on a daily. So this is a daily chart. This was taken, I think, yesterday, so it's not accurate. We're actually down lower now, like about 4160-ish on the futures last time I looked. But this is a daily. The average true range now has moved. This is a daily chart, but this average true range is based on a week. So now we're at about 211 move that you can anticipate on a week on average for average true range. So now I want to tell you something. I want everybody to listen to this because this is important for swing traders. Okay. The average true range for the month is I think it's about 240. The average true range for the week is 211. To me, that says there's a lot of opportunity for swing traders to the upside and to the downside. Average true range on the daily is about 45. Average true range for the week is 211. And look what happens to be in that target area on that average true range. Woo, look at that number. 3,800. Okay. Now it says 3,808. Who cares, right? But that's how I come at these numbers. And that's why when I hear these guys say the same numbers that I'm looking at, I listen, I pay attention. I so pay attention. It is so valuable. It's valuable to me. And I think it's valuable to all of you who are listening. Now, I am settling on, I am conflicted when I see what the bond market is doing and what the equity market is doing and what the Fed is saying, what they're doing. I just come back to this. This is what I've settled on. I'm not saying anybody else needs to settle on this, but I'm just kind of settling. I don't fight the Fed. I think that we will go up to that kind of 4,300 area as well. I just showed it to you on the screen, showed you how I came up with it as well. And I think that timing is going to be, it could be, this is not written in stone. It doesn't have to be exact. I'm just using it as a gauge. But I think that time frame is going to be right when that Fed does make it its announcement, that May 3rd, May 2nd kind of time frame. I think that will be.
You kind of see it rallying into the meeting, and then maybe it'll bounce off pretty hard off that 4,300.
I think that I think that we're going to see a nice bounce, just like we saw with that 4,200. That's my personal opinion.
Yeah,
that's my personal opinion. But we shall see. And I
Awesome.
won't hold myself to that. I'll just trade whatever the numbers tell me at the time. I don't think this is going to be a straight line up. I mean, obviously we've already pulled, but you can kind of see in this area the last several days, kind of a pretty narrow channel moving up.
Yeah.
We might have kind of a narrow channel through April. And then in that May kind of pull back, which kind of fits the conversation that we've been having.
Yeah.
So.
Awesome. Okay, great. Celeste, thank you very much. Is there more here? I'm sorry, I didn't know.
Yeah, got a couple more things, but you can cut me off. I want to show you something, because this is, if you haven't seen this, I sent it out on my Telegram. This is also going based on when you had the last 6 months low, what happened. And we had that 6 month low in October, 6 months later. This is just historical data. You can throw it away. You can use it. You can do whatever you want with it. I love it. And it's what gives me confidence to trade even to the upside when what I see is just such junk. And we were talking about that junk earlier in the show, this, nothing else. I don't need to say anything else, but that's that. I think that's a pretty cool chart.
Awesome. Excellent. Thank you, Celeste. That's great. Appreciate that. Love your insight there. And yeah, I mean, I guess I can infer from what Roger and Jeffrey were saying is they see that move up higher, and we'll see how the market reacts to what the Fed does for sure. It's all a waiting game right now. We'll be through earnings to keep the people distracted for a short time, and then they'll be focused right 100% back on the Fed. So we'll see how that goes. Roger, why don't you take us into some earnings talk here. I know that you and margin. The big thing is
two things.
Is your view on margin rates and paying for the short sellers.
Yeah, so there's a couple of things I want to talk about. Before, I know a lot of folks are getting a little too excited because earnings have been better. I mean, there's been like 40 companies that have reported, and some of them have been 90% have beaten expectations. But I want to tell people right now that I don't want them to get too excited about earnings, because I think earnings are going to get nastier before they get better. And according to statistics, and I'm a big statistics guy, if you look at the ISM Manufacturing Index, which measures the level of activity in part of the economy, it dropped to about 46 from March, from a post-COVID peak of about 60. And historically, a weak ISM result has shown that less than 70% of stocks outperform expectations on earnings. And so far we're at 90, and I think those numbers are going to get down really, really fast, really, really hard over the next couple of weeks. We're already seeing some duds out there. So folks, don't get bullish on earnings just yet. We're just starting out. And we actually got revised higher from the 30 companies or 40 companies that came out. But most of them were big bank stocks, and they were beaten down already in terms of estimates after what happened with the banking fiasco. The problem is they're not going to be the ones that get hurt. It's the regional banks that are going to get hurt. So be very, very careful and be very mindful that we are just starting earnings, and earnings, if they're revised lower, they can cause a significant shift in the gravity of this market. And again,
Roger, to that point, and I kind of mentioned that at the beginning, so far we're looking at the biggest earning season so far, but that's a result of everybody, I get it was a Whitney and everybody else bringing those expectations down, expecting the worst. So as far as like the consensus estimates, the other way of saying that is they've never been so low, and they managed to be the lowest bar ever, right? So
exactly. And even with that low bar, they're still not going to beat expectations. So it's kind of like, I think they're going to get really nasty really quick. And I think we're going to see a repeat of what we saw last quarter, which was a huge, I don't have the numbers in front of me, but it was a huge revision lower from the beginning of earnings all the way till the end. It was devastating, actually.
Yeah. So far, S&P earnings are off 10%, I think, off their peak in 2022. Probably got quite a ways to go from there.
Yeah, so. They got quite a ways to go. So don't hold your breath for great earnings, and be very mindful. That's the first thing I wanted to talk about. The second thing I wanted to talk about, and this is really interesting, a lot of folks look at open short. I think this is something cool, actually, that a lot of people don't realize unless they've been or they're in the institutional business. A lot of folks focus on short interest in order to see if a stock is ready for a squeeze. And they're always looking at short interest. They're looking at short interest, but what they're not looking at is the amount of money that's being charged on the interest for that short interest. And there's a research company called S3, and what they're doing is they keep track of all the money that is paying for keeping that short interest alive. And if I'm a hedge fund guy and interest rates have been kind of high, the longer I hold my short, and I'm obviously on margin because I can't, you have to be on margin to have a short, you're paying interest. And if you're paying interest, that's going to take a chunk of it out of, now, obviously, if you're holding a short for 2 days, it's not a big deal, but these are not swing traders. These are position traders. And a lot of these funds and a lot of these institutional traders are getting their alpha taken off of them because they have to pay for that margin. So it's a very sneaky way to see which stocks are ultimately maybe susceptible to a short squeeze, not because there's too much open interest, because there's too much open interest that they have to pay for.
Right,
and that's
the carrying cost.
The carrying costs, yes. And that's a huge thing that nobody's talking about. It's like it doesn't exist, but it does. It exists. There's no free money out there. So short interest in the US and Canada markets combined rose 8.7% in the first quarter to 977 billion. 77 billion increase was made up in shorted share prices increase. Now, short sellers paid 1.91 billion in stock borrowing fees during the quarter as calculated from daily borrowing costs by S3. That was up from 1.54 billion last quarter. So it's almost 25% higher. And with interest rates going higher, that number is really, really up. So let me give you guys a list of the stocks that have the highest carrying cost. Instead of giving you stocks that have the highest short interest, I'm going to give you a list of stocks that have the highest carrying cost of any stock on Wall Street, because if interest rates keep going up, there's going to be a lot less interest in holding those stocks. So I'll put them for you right here. AMC, I'm writing them down right now. I'll post in a second. EVGO, Beyond Meat, Nikola, QS, XPEV, GameStop, that's probably, everybody probably guessed that, FSR, and LSID. That's the list of stocks that have the highest carrying cost right now on Wall Street. And if you guys are interested in how real institutional traders focus, you got to go one step further sometimes. Don't look at short interest. Look what they're paying for that short interest, because that's going to make all the difference in the world. And if that takes out of alpha, which it is, I mean, think about it. If they're holding these short for a year, that's going to take like what, 7-8% out of their alpha.
Yeah, I was going to ask, what are the rates? What are the rates on those? Is that what it is? 7 or 8%?
It's somewhere between 7 and 8% right now. So this is not the economy where they're paying 1.5-2%. They're actually paying money for this. And when their fund, I know this because I remember them like, what are you paying for this short? What are you paying for this short? Because I was doing this in early 2000s where rates were right about where they're at right now, maybe a little bit low, maybe a little bit higher, but it was a big concern. And in the last 4 or 5 years, nobody really cared, but now it's a big problem. So if a fund says, okay, enough, we've had it, we don't want to hold this for an extra couple of days because we're paying too much. It's just taking too much out of. We're not going to make money even if we make money, Right. So they're going to let these shorts go, and boom, you can see a nice short squeeze based on these. But that's the stocks that are being charged the most on Wall Street right now. And I thought it pretty cool to expose them for what they are.
Nice.
Yeah. No, that's great. That's great. And that's kind of the guts of how the market worked, right? So for sure, those borrowing costs can get really painful when they're on the wrong side of those trades, and makes it easier, I guess, for the Wall Street bet guys to go out there and squeeze them out,
right? Big time.
Yeah. And so what overall on the earnings here? We've got anything else you wanted? We've talked about earnings a lot. I didn't know if there was anything else you had to add to what we're seeing so far, or
not yet. Honestly, it's just too early. It's way too early to see what's going on. I'm being very very cautious right now, and I'm basically focusing on the top stocks right now. If you'd like, I can give you a list of some of the stocks that I'm focused on right now. Actually, I'll put them up. I'll pull them up.
Yeah, why don't you drop those in there? And in the meantime, Jeffrey, I know while he's dropping those names in there, what I know we got you to you got something to tell us. You got a new way of looking at options and some very short-term stuff. Let's hear it, man. Can we let's talk about it?
Yeah, so I'm just gonna throw this chart up behind me here. I don't think I have screen share rights, but kind of see it there. I see if I can share the screen really quickly.
I think you can share the screen.
There we go. There we go. There we go. So now it's behind me and on the screen. This is a 20-year seasonality of the VIX right here. What I have up. Now we saw a big freak out and a spike in VIX mid-March. I got into SVXY, which is a short VIX play, looking for it to return to normal. And we've kind of made that little dip right here. We may see a little bit of volatility come into the market, just a little bit. We may get a pullback. And then seasonality, 20 years says we see a drift on off, which would indicate the market moving higher, a little bit of calm in the market as we get to the end of April. Then volatility picks up in May and drops off to that ultimate low late May. Then more volatility. That's like the sell in May a little bit. And then we see some more summer volatility before we go back down to a low in July. That's kind of my plan. That's choppy. That's what I see. Some choppy action from now through July, really. That can make it tough. That may be the bouncing back and forth between Celeste levels. And, one thing to keep in mind too, as we look at earnings and the rest of earnings coming out, we're just in the first few financials, a couple big tech. We had Netflix last night, Tesla coming out later today. After the market closes, we'll find out what they have to say. But a lot of these zombie companies that we've, heard all about here and there, something like 70, 80% of companies, depending on whose numbers you use, are zombie companies that basically just make enough money to pay their debt. Mm-hmm. Now we're in an environment where money is getting more expensive. And it's been like 20 years since we've had expensive money, really expensive money.
Yep.
That's a whole generation of CEOs and top directors and stuff like that have no experience operating a company in an environment
when they really have to worry about paying their debt.
Right. Yeah, where money's expensive. And so if you've got a company that has less than 12 months of cash on hand, even if it's, especially if it's borrowed cash on hand, they're going to have a tough time getting more cash at any kind of reasonable rates to fund continuing operations. So this is not like an immediate problem, but this is a problem that could come to head, say, out in the fall when we see this spike in volatility out here.
Yeah. So there's lots of things converging right now. So the and everything, honestly, over the last month, since the banking crisis, everybody's back to assuming everything feels pretty good, right? But and we talked about this 2-3 months ago. Well, not that long ago, 2-3 weeks ago, about credit default swaps, right? So credit default swap is a way of you can either sell a credit default swap, earn a premium, and you're betting that the company doesn't default, and you own a credit default swap, and that means you get paid off if the company indeed defaults, right? And so that's a way to swap.
Let's break that down just a little bit. Let's break it down just a touch more so everybody understands. A lot of people have a hard time here. If you borrow money from somebody, you're taking credit, right? Yeah. The person lending you is giving you credit. Now, how do they ensure that you might default? Well, they can go to the market and buy these CDSs, credit default swaps. That was a big player in the 2007-8 great financial crisis, where these credit default swaps and mortgage-backed securities, both of those are kind of coming into play. Right now we have commercial mortgage-backed securities that are coming into play, commercial real estate, CRE, if you've heard it in the news. And so a lot of people are buying those credit default swaps, and like UBS, who purchased the assets of Credit Suisse, however you say it, is now one of the major suppliers of credit default swaps. So UBS is kind of selling, buying a bunch of risk from people that lend to issue these credit default swaps. And the default swaps only pay when people default on their loans to the people who are buying the insurance. So just to try to catch up the audience to what in the devil a credit default swap is, because as I've talked about it, people have a lot of confusion about what the heck that even is.
And it basically prices in the odds of default, right? And so the higher the default risk goes, the more expensive credit default swaps get, and the more you can earn by selling that credit default swap. But the interesting thing is the U.S. government credit default swap just hit an all-time high. Right. Yeah. We're here and we're going into this debt. Part of that is probably the debt ceiling debate and some of those around that. But, we're talking about the Fed. We talk about the bank crisis. but this the credit situation in terms of just credit ratings and ability to repay in general doesn't get a whole lot of press time. And you're bringing this up in the context of the CEOs, and then also just in general, the U.S. credit never has been more likely to default based on what the market is pricing in, right? So that's crazy. And I just see a comment here. How does anyone buy a CDS? You as an individual do not buy a credit default swap. that is an institutional game. So that's not, but it does give you credit default swap prices do give you a price of what how markets are expecting default. So within all of this, the U.S. just got
beyond the scope of our conversation here. There are companies that buy CDSs and then sell bonds on the CDSs in the market, but that's a whole different conversation and whole set of rules of engagement you got to learn that's separate from just staying in the stock market. I mean, it can get very complicated and convoluted.
Well, that's great. So, and I know that. So, Jeff, you've been killing it. You're a very active trader. You've got you've been pulling returns, putting on trades that turns into a winner as a matter of minutes, hours. That sort of thing.
One of the points I wanted to make with all this volatility I'm kind of predicting here is that if you can just simplify what you're watching down to one ticker and just watch it for 1 hour of the day, like that's the beautiful thing. And Roger and I are going to go live and talk about this a couple of times here after this. And I've got a link to throw in the chat.
Oh, that's great.
I'll throw this link in the chat. Oh, wrong link.
So what is it? You focus. So what you suggest to people just find one ticker and focus in on that. And then you can really spot something.
Yeah. So really, if you can just simplify it, like instead of worrying about what the next earnings are, who's going bankrupt, who's blowing something up, if you can just focus down on one ticker that has a repeatable pattern that occurs virtually every day, like my back test, 5,300 trades of back testing, said it happens 70% of the time, like clockwork. I know Roger's a big back test guy.
Big time.
21 years of data I pulled, and this keeps happening 70% of the time. So I've set up this trade where you can take it like clockwork, and 70% of the time it does a payday. The track record is showing 13% gain on winners and losers. And if you want to find more about that, we've got the link in the chat there.
1 o'clock, folks. It's going to be a great time. Don't miss out. It's going to be a lot of fun. You don't want to miss this class. I'm very excited to be there, Jeffrey. So it'll be a lot of fun. We haven't done this in a while.
Yeah, I've never really presented anything with you, Roger. So this is going to be our first one. Like I said, I built a huge back test that you're all about back tests. So we'll have it there to talk about. So
beautiful.
Awesome. That's folks. Great. You guys, Jeffrey and I get to talk a lot. He casts a wide net, right? He focuses on, he works with crypto, in and out stock trading. He covers the gamut, and he has a lot of insight on a lot of things. And he certainly does a lot of homework when it comes to analysis and developing these systems that he has. So I would strongly encourage you guys to check that thing out.
Definitely. It's going to be a lot of fun. I'm looking forward to it.
Yeah. Awesome. Okay, guys. Well, this has been, go ahead, Celeste, you said something?
No, I was just going to say, I mean, it's just like when these guys speak, I listen. And so Jeffrey Turnmeyer, Roger Scott, two of my favorite people, I'm going to be there. I want to hear what they have to say because it helps me. Again, I feel like a broken record, but it helps me to make money. And that's why we are all here. And so whenever you can get an edge, I mean, Jeffrey Turnmeyer just laid out the case for you seasonally, what's going to happen this summer. We've talked about what we think is going to happen this summer. We're saying the same thing. Do you think I want to get a way to trade and reduce stress, just like Jeffrey was just saying? You betcha. I want a simple way to make money because you know what? I have a whole lot of other life to live other than being in front of a computer. And I think that you all do as well. So I'm going to be there. I think it's going to be fantastic. Thanks for bringing the opportunity, Jeffrey and Roger.
All right, you guys, click that link, join there. It's at 1 o'clock today. So, between him and Roger, that's a lot of brain power right there and a lot of money making, a lot of ways to make money. So you guys definitely got to get on that. Hey guys, thank you very much. This has been an excellent discussion. Roger, Celeste,
thank you all.
It's awesome. Jeffrey, thank you very much for jumping in, especially at the last minute. You really added to the conversation. We love having you here. That's it for today, guys. Everybody have a wonderful day. a wonderful week, and we'll catch you next week on Roundtable.
Thank you. Thank you, Don, for having me. Bye, guys. Bye, Celeste. Bye, Jeffrey. Bye, Don.
Thanks.
Bye, everybody.
All right. I got 10 minutes to eat.